Welcome to the Stockout. The Stockout is your show at FreightWaves for all things related to consumer packaged goods or CPG companies and their supply chains. I'm Mike Bowden-Distel. I'm the head of Intermodal Solutions here at FreightWaves. In addition to covering intermodal, also follow the CPG industry, and a lot to talk about today. There were a lot of companies reporting earnings last week, but I'm not going to dwell too long on that because there's plenty of other shows, FreightWaves, and analysts cover those and what have you. But also going to focus on what's happening in the freight transportation industry. I'll touch on sort of the three major areas that we cover here at FreightWaves with our data. Those are being ocean, rail, and truckload. But first, just want to give a shout out to our sponsor, which is RJW Logistics Group, which was kind enough to sponsor the Stockout show and newsletter for the month of August. Hope to have RJW on a Stockout show here in the coming weeks. Please go to www.rjwgroup.com. So that's easy one, rjwgroup.com. Logistics experts do a lot with CPG and retailers that can find out how they can help you. So with that, I'll start with sort of what's happening in the world of CPGs in the last couple weeks, really in the last week. A ton of companies reported earnings, and I think sort of the big theme is that there's more evidence of consumers changing their behavior in response to inflation, in response to just not feeling as good about their financial situation overall. And I really think a lot of companies saw this coming, and sort of we get to this question of, is the elasticity that consumers have for CPG companies, is it going to be sort of in line with what it was historically? Is it going to be better? Is it going to be worse? But clearly, I think some of the results posted by some of the CPG companies are at least showing that CPG companies are not immune to consumers changing their behavior. They're less sensitive than, if you look at some of these companies like Best Buy reported last week, and consumers don't have to buy any of those electronics, but CPG sort of essential items sort of varies. There are also some alternatives. But when you sort of look at what happened last week, Proctor Gamble reported expects slowing sales sort of in their quarter. They had organic sales growth of 7% on 8% pricing and organic volume decline of 1%. There you're looking at the Procter & Gamble stock chart for the past 12 months and kind of back to where we were a year ago. And the CPG companies in general have been strong performers this year and have held up a lot better than other stocks. There's been sort of this shift towards the quality names that are less volatile, and Procter & Gamble has been one of the beneficiaries of that. Their shares were down about 6% after they reported last week. And I think what was concerning to some of the street is they said that the shift to private label has been small, quote, small but noticeable. That's a trend I think that a lot of CPG companies are seeing. There's some evidence from IRI, a company that follows CPG companies very closely, that the store brands, those private label brands, now have about 21.6% market share, which is actually higher than 2019 levels, sort of this reversal of what happened during 2020 when these big national brands took share from the private label brands. Maybe that's because their supply chains were in better shape. There was more product on shelves, maybe because consumers had more disposable income. Maybe it's just because those national brands gave consumers comfort in a time of uncertainty. But for whatever reason, the national CPG brands gained share during the pandemic. They seem to be giving a lot of that back, if not all of it back. And getting back to Procter & Gamble, their sort of the elasticity that they're seeing, at least so far, sales growth about 7%, 8%. That's on 8% pricing, 1% volume decline. That's actually pretty solid. If companies are able to take up their prices 8%, only see volume decline 1%. And you can sort of draw a contrast to what they just saw in that last quarter with what they saw for the full year, which was prices rose 4% and volume rose 2%. And that's kind of what we're seeing across the CPG industry, is because consumers are expecting price increases. If these companies raise their prices 4, 5, 6%, they're generally able to maintain volume growth if they take their prices up to sort of fully reflect what's happening on their cost side, which might be 7, 8, 9, 10%, maybe more than that. That's when you're starting to see volume take a hit. That's pretty noticeable. Procter Gamble said they expect organic sales of 3 to 5% in the upcoming year. Last year was 5%, and they said that the rising prices are slowing CPG industry growth by about 1 percentage point. I think, if anything, that's maybe being too conservative, and it does seem like the consumer is just sort of starting to sort of fully pull back, and there's maybe other shoes to drop there. Procter Gamble also interesting. They said that core earnings grew about 3% despite the headwinds from commodities, freight, and foreign exchange. Core gross margin declined 370 basis points year over year. That's a trend that we're seeing sort of across the CPG space. I think you sort of go back about a year and a half ago, early 2021. I don't think most of the CPG companies were expecting their costs to rise as much as they have, and as for as long as they have. And so a lot of those companies were caught with rising costs, and they couldn't fully pass those costs on with higher price increases. So you did see lots of CPG companies really across the board see margin deterioration of several hundred basis points. Procter & Gamble is just one of those companies. Last quarter, 370 basis point margin decline. That's something that lots of companies are dealing with, and it's not just rising commodities and ingredients. It's also labor, contract manufacturing. A lot of these companies have had to go outsource a lot of their manufacturing to third parties, which is very expensive, cuts into the margin. I think as volumes decline a little bit, that's one of the silver lining for CPG companies, is they can bring more of that manufacturing in-house, should actually help mitigate some of the margin pressure. So that's a little bit of what we're seeing from Procter & Gamble. Their big competitor Unilever also reported last week, and something that they added that didn't hear from Procter & Gamble is they said U.S. consumers are shopping more in physical stores. They're shopping less online. That's something that we've seen from some of the online retailers, saying that that pandemic behavior of the huge shift to e-commerce is starting to reverse itself at least a little bit. Some of that is just fewer, impulse purchases. Some of that is just, consumers going to more of the big box retailers, sort of these big stock up trips. Unilever also said that there'd be a negative impact on volume with pricing above what they have is a range of 4.5% to 6.5%. So not a surprise that consumers are, cutting back there. And they've cited a bunch of, different input costs that are causing them, pain. Crude oil, of course, also crude palm oil and palm kernel, that's the input that comes from, largely Indonesia and Malaysia, that goes into a wide range of consumer products, a lot of, personal care products, even goes into ice cream. That's something that's been in short supply and has been exacerbated, like so many commodities have, by the war in Ukraine, because that palm oil is competitive with sunflower oil that comes from Ukraine. Unilever also, cited, aluminum having a pretty significant, impact. And so their gross margins declined 180 basis points, 8.6% cost increase, more than offset a 6.5% increase in price. And so that's kind of why this has been a difficult time for CPG companies. It's just the cost rising faster than their prices. I think going forward, the big question is, are they going to have additional rounds of pricing? And I think Procter & Gamble sort of partially answered that in their earnings report. They said, expect another round of, let's say, 4 to 5% price increases in the coming months. And it also gets to the question of, are retailers going to be accepting of these prices, or with commodity prices, off of their highs, if those, continue lower, are the retailers going to say, no more, price increases? I think the relationship between CPG and retailers have gotten to be a little bit more contentious, because the CPG companies have come to them so many different times, asking for price increases on top of price increases, and the retailers doing more with the private label brand. So it does look like companies like Treehouse, which is a big company that makes a lot of the private label brands, for companies like Trader Joe's, Kroger, et cetera, they're in a pretty good position here going forward. I'll move on to topic number 2, and this I'm sort of reiterating and taking from what Zach Strickland's chart of the week. Zach Strickland, if you don't follow him, he's the Sultan of Sonar, knows the sonar data at FreightWaves inside and out, and he wrote a good article over the weekend. How far will contract freight rates decline? He was speaking specifically about truckload rates, and we have a chart on that. And so in this chart, the blue are contract rates, and so most of the big CPG companies, that's the market that they play in, is a contract freight market. Generally 1-year contracts, and in green are spot rates, and these are on a comparable basis where we're excluding fuel. And in green, we're sort of assuming that the base level fuel costs about $1.20 a gallon, and what you see there is really ever since the beginning of June, the spot rate, June of 2020, so about 2 years, the spot rates for dry van truckload have been higher than the contract rates that ended in February of this year. So call it a year and 3/4 of spot rates above contract rates, and the spot rates have fallen very significantly, and now they're about 75 cents per mile below where contract freight rates are, and that spread is not sustainable, and it is about 3 times wider than in 2019, which was thought of as being a weak freight market. There were lots of truckload bankruptcies in 2019, and the natural conclusion is we would expect to see the contract rates start to decline for freight, and that's good news for CPGs. I haven't heard any CPGs come right out and say, well, this is a headwind, we have lower freight costs. They've all said kind of the opposite. They've said freight is still a headwind because those contract rates are higher than the contract rates they were paying a year ago. Most of the CPGs are moving sufficient volume that they play in the contract market and sort of more stable volume. So contract is a better option for them, but would not surprise me at all if the CPG companies started to get a more aggressive, with the contracts. Zach predicts the 3 to 5% decline in freight rates is kind of a conservative estimate in the coming months. It could be steeper than that when you look at how much spot rates are down from their high. Let's say a few months ago, they're down about 27%, and that is since the beginning of March. Meanwhile, contract rates down about 2%. So it does seem like contract rates have a long way to fall. That seems to at least eventually pay into CPG companies' favor, combined with maybe commodity costs, which are hopefully off of their highs. Maybe the labor market gets a little bit weaker. So you sort of look at what's happened with CPGs with their declining margins over the last year and a half, and you sort of say, well, maybe going forward, that's as thin as those margins are going to be. Can we get to a point where the margins start to rise? I think that's sort of a logical outlook. So at least be bullish on CPG's margins. And the other big question, like I talked about earlier, is the elasticity going to continue to stay low, at least lower than it has been historically, which the CPG companies have seen so far. So I'll move on from truckload to rail, area that I follow closely. And Canadian Pacific added some detail last week of its merger with Kansas City Southern. Sort of where we are there is Canadian Pacific is expecting approval from Surface Transportation Board, the organization of the U.S. government that economically regulates the U.S. railroad. They're expecting that approval in early 2023. So it does seem like it's a slow process. There is going to be a 3-day hearing, on the merger in September, where those that are opposed can take their grievances to the Surface Transportation Board and say how awful they think the merger is going to be. Canadian Pacific, for its case, has cited that there's been a lot of shippers that are on board with the merger, and I thought the comments last week were interesting, where CP gave some additional detail on what they've been doing with their operations. And they said specifically that they've tested 6 or 7 trains from Lázaro Cárdenas, which is on the west coast of Mexico, port city on the west coast of Mexico, to Chicago with 7-day transits that's competitive with intermodal service from the ports of LA Long Beach to Chicago, which is currently by far the densest intermodal corridor in the United States. And so that could potentially be a service that takes share from the port of LA Long Beach. Those ports seem to do everything they can to price themselves out of the market with very high labor costs with the ILWU, and they're some of the most inefficient ports in the world with less automation. And a lot of that has to do with the unions, which won't allow more automation. So that's something investors are excited about. They have been for a long time. CP and Kansas City Southern, likely being under one corporate umbrella, they can have investments on both sides of Kansas City. Seems to be a boon for shippers, there. Another thing they talked about is on the domestic intermodal side, more service out of Chicago to Laredo, talking about a 90-hour transit time from Chicago to Laredo. Had been thinking about that more maybe from Chicago to Dallas. I mean, sort of these north-south corridors for rail. Intermodal is really punching below its weight class, but it seems like that's a logical way to get auto parts from the auto part manufacturers that might be located near Chicago or in Detroit, and get those across border to the Mexican assembly plants. The rails then will move the finished vehicles back, north across the border for U.S. consumption. So that seems like a big opportunity in extending the Canadian Pacific's reach. They also talked some about grain and bulk commodities, and CP was talking about moving grain from Manitoba to as far south as Mexico City, which opens up the possibility for farmers in Canada to move their grain into more locations. I'd say one of the pushbacks, for the Canadian Pacific Kansas City Southern merger has been from U.S. farmers that are concerned that they will lose share to Canadian growers if they can more easily get their crops from Canada to consumption centers in the U.S. or to all the way to Mexico. And Kansas City Southern actually moves more across the border south from the U.S. to Mexico than vice versa, because they have such a large grain franchise. They move a lot of grain south. So that was interesting. They also said that it opens up more possibilities potentially for potash. Potash is a big fertilizer commodity that's largely moved from Canada to the export markets through the port of Vancouver. But maybe now more of that will move to agriculture regions in the U.S., potentially Mexico or out other ports. So a lot that could change there, and I think all of this sort of makes the case that this is in the best interests of the public, which is one of the hurdles that CP has to clear in order to get this approved, and that it actually enhances railway competition rather than detracts from railway competition, which is the main thing that the Surface Transportation Board is going to be looking at. If there are mitigation measures, which there likely will be, it's probably going to be what the Burlington Northern Santa Fe has requested, which is to make sure that there's nothing anti-competitive about Kansas City Southern's unique access to the Laredo, gateway right near the border of U.S. and Mexico. I think the concern would be that with CP and Kansas City Southern under the same corporate umbrella, that they would give preferential treatment to freight that started on the CP and goes to Laredo to Mexico, rather than that started on, let's say, Union Pacific or Burlington Northern that makes that same trip. So that's one thing to consider with that. I'll move on to the next topic, which is on the container side. And the overall container ship backlog hits a new record. This was from an article written the other day by Greg Miller, who follows the maritime industry extremely closely. So basically, there's been a shift in the backlog of container ships waiting, and you recall all the headlines of the container ships waiting off the coast of LA and Long Beach. 100 and something ships at one point. I think 109 in January were waiting in the San Pedro Bay. That's down to 26. But all is not good on the water because there's been an increase in the ships waiting, on the other ports on the Gulf Coast and the East Coast, and now there's actually a 153 total ships stuck in waiting off of the various ports in North America. That's up 66% from June. In the past several weeks, some of the ones that are most impacted there is Savannah, Georgia, about 43 are waiting. Houston, about 24, and that seems to reflect the shippers' desire to avoid the port of LA. That could be related to the labor issues. The longshoremen working without a contract. That contract was supposed to roll over July 1st. They're still in negotiations. There's always the potential that even if there's not a work stoppage, that those facilities will operate less efficiently. So there was a lot of movement to other ports, sort of in anticipation of that. There's also been a tremendous amount of rail congestion at the ports of LA and Long Beach, with a very large portion of the containers sitting for longer than 9 days before they depart on a railroad, and sort of the rail congestion has been kind of the main constraint there, with the truckload market easing up at the port of LA. And all that's taken place despite the fact that there's been a cooling in overall ocean demand. Have a chart on the ocean TEU volume index, and so in blue is ocean TEU volume index. This is from our maritime product from China to the U.S. You've seen that drop off quite a bit, and moving right along with it has been the Freightos Baltic daily index. In green, that's from China to the U.S. West Coast. So volume is in blue in this chart. Rates in green. You've seen both of those, come way down, which is because there's been a slowing in overall, demand. With the inventory, retailers' inventories, being at a very high level for a lot of general merchandise. And that's one thing that's actually contributed to the rail congestion, because you recall last year there were shortages of international shipping containers. With demand coming off, there's no longer a shortage of those international shipping containers. So the container ship lines much more willing to send those containers, those ocean-going containers, primarily 40-foot containers, intact into the interior of the United States. That's created a lot more rail congestion at locations like Chicago. So it's kind of we're swapping one problem for another. But I do think that chart I just showed sort of reflects decline in sort of global consumption, and the fact that retail inventories are bloated, that warehouse levels are at a very high level, and really would expect a muted peak season for ocean imports. I think maybe this is our peak season once we get through back to school. It seems like there's going to be a lot already, in inventory that maybe don't really need to have that big fall surge that you typically see. You typically would see a big surge in rail intermodal volume in October, followed by truckload in November into December. But it does seem like that's cooling off some. Before I leave you today, I'll just give a couple of macro updates. Was just listening to our chief economist at FreightWaves, Anthony Smith, talking about the macro side. GDP down 0.9% in the second quarter. I guess according to him, we technically are in a recession. Real disposable income declined 0.3%. He sees a rising trend in jobless claims. Savings rate at the lowest level in 13 years, and saw that fewer people are paying their AT&T bills, and that's kind of an interesting economic indicator for those that kind of live paycheck to paycheck. That's something that you wouldn't want to get rid of if you're getting your cell phone and or internet from AT&T, like you would here in Dallas. So not a lot that's positive on the macro side, maybe with the exception of the job market is still fairly tight. I mean, do think that tends to be a lagging indicator, but most of the forward-looking indicators does seem like the consumer is getting squeezed, and likely to see more of that fallout here in the coming weeks. So with that, that's really what I wanted to go over today. Feel free to sign up for my newsletter at www.freightwaves.com/the Stockout. You can get that pretty easily by going to freightwaves.com up to newsletters. And then first one listed there is the Stockout. We focus on CPG. Also, we'll talk about anything I see that's interesting in the freight markets and freight waves, sonar data, et cetera. Lots of other good ones there, including point of sale for retail and a transmission on the automotive side. So with that, hope everyone has a great Monday.